tax advisor prior to investing.
Well, good morning. Happy Monday. It's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth. And this is a show about money. We talk about money on this show, and excited to be able to have you on board here in the last coming days of October. And we talk about the market here on WVLP FM 103.1. It's a local Valparaiso community radio station here, and also podcast on iTunes as well as Podomatic. You can find us under Money Matters with Greg. Find us there. I'm a registered financial advisor and owner and CEO of a wealth management firm that is local here to Valparaiso, but also working with clients all throughout the nation. We work as a team with a number of different people, as individuals and companies. We talk 401ks, we talk estate planning, we talk holistic management on a number of different things that help you as to where your wealth is and how we can help grow and create your wealth, protect and preserve your wealth, distribute your wealth in your lifetime, and also distribute your wealth after death. So those are some of the things we talk about here on this show, and we're excited to be with you here today to talk about the market. It's about a half an hour show. We kind of go through what the market has gone on in the last week or so, kind of review what's going on, what's in the past, what's in the future here. As everyone knows, we've had quite a great ride here in regards to the stock market. We also talk investing in regards to your real estate holdings, let's say your commodities or anything that you like to be able to talk about as far as natural resources, you name it. We feel like a diversified portfolio and many different asset classes to you and your family will help you achieve your goals. So we'll talk about the market here real quick and kind of review what's going on with that. And then I want to get into how healthy is your life portfolio. It's a new piece we've done that we have out there in regards to our thought leadership program. To be able to just sort of, we have these come out about once every quarter or so. We try to get them out and put them on our website, put them up so you can read them. They're free to you. So please check it out when you get a chance. It's also our thought leadership on how healthy is your life portfolio and what exactly that means. We're going to talk a little bit about that in the second part of the show. You can always email us. Greg@farrellwealth.com is my email. I'll be happy to hear from you. And also we're on Twitter at Farrell Wealth. You can find us on Facebook as well. And many of the different things that we're researching or talking to clients about is what we post. So please feel free to dive in and learn something. This show was established so you could add some value to your lives in regards to money, and many of the guests we have on the show are related to that, and it's just sort of help you out every day with different things to be able to hopefully save you money. So that's our show. That's what we've been doing here. We've sort of been changing things up recently. We're going to be adding some snippets from guests that we've interviewed and plug them in as we move along here in the show. So we're really excited about that because that's going to be in the next couple months moving forward to sort of add even more value to you and your family. So with that being said, any questions you have, 219-476-9000. We'd love to hear from you. If you're willing to talk about sponsorship as well on this show or any other show at WVLP, we'd love to hear from you. There's some fantastic shows that are on WVLP, some great insiders and some great insights and some wonderful music as well. So feel free to contact the station, 219-476-9000 for that. And love to hear from you. In the meantime, so what happened last week is the update. Basically, the market was mostly higher, really, for the busiest day of the week. S&P index was up 0.1 on Friday. The Dow was up 0.3, and the Nasdaq was down 0.1. So pretty casual day. But for the week overall, really there was one big leader, which was materials. The materials led big at a 1.3% on solid results from chemicals, followed by financials, telecommunications. Healthcare lagged on biotech, pharma underperformance, but for the most part, it was a really solid week. Crude oil was up 0.9, almost 1% to $52.65 a barrel, and that increased since the highest level since April. Gold dipped slightly, almost over 1%. It's trading about $12.67 now. Just a few weeks ago, when we were talking on the show, it was trading well over $13.50 or close to $13.50 an ounce. So it's dropped nearly almost $100 an ounce, which is a considerable amount considering where it is in regards to the price. So that's over $100. It's a pretty big drop. It was down 1% last week. We're going to talk about the central banks in a second, but the big central bank Fed headline right now is the perceived dovish commentary from the ECB and Janet Yellen. Reportedly, Janet Yellen is out of contention in regards to the Fed position, and so that'll be interesting to kind of see what happens in regards to moving forward overall with the Fed. But really, the big story on Friday was tech. Nasdaq was up 1.5%, and you saw a lot of different companies: Amazon, Facebook, and the FANG stocks that we talk about in this show much of the time, all higher. So, what are we looking at really? We always talk about sell in May and go away as a sort of a quote that's really one of the most powerful comments that always happens in May. That sell in May and go away as a May to October period kind of historically is weak for equities. Well, the good news is that we're going to close in the best 6 months of the year. If you sold in May and went away, like we talked about in our May show, it would have been extremely erroneous on your part in regards to the market. But if you go back to 1950, the May to October period is up an average of 1.5% for the S&P, while it is up 7.0% on average for the other 6 months. Today we're just really sort of looking closer at what exactly that means, and just to make sure we mention it. It always is much more volatile in October. We've had a little bit of volatility overall, but nothing like we normally have in volatility. But the big number that kind of came out in addition to all the numbers we're talking about here was the third quarter GDP. Third quarter GDP beat expectations. The advanced estimate for the third quarter came in at 3%, and this is well above the 2.6% expected, and it was just slightly below the second quarter's 3.1% rate of growth. Consumer spending was a main driver for the beat, and though really business fixed investment also picked up, but the Bureau of Economic Analysis didn't really mention the impact of the hurricanes directly. But at least part of the gain in consumer spending was driven by motor vehicle sales as consumers replaced storm-damaged vehicles. Given the geographic scope of the hurricanes was really limited, and the fact that the growth came in as strong as it did, it really continues to point to the strength of the U.S. economy. It was expected that the hurricanes were going to affect growth considerably, and that just, in this report at least, we'll see what happens in the next month as we get more data. But in this month, it necessarily wasn't as bad as to be expected. One of the things I want to be able to ask a question, we got on Twitter that was a really good question talking about what does the ECB mean? What does ECB mean? This is the European Central Bank, and they've been in the news lately about tapering their bond purchases, and they've been still pushing and buying bonds in regards to their economies, trying to prop up as much as they can. They've gone from, they were at 60 billion euros, and they're going to drop that to 30 billion euros per month starting in January 2018. So that was the news that came out of the ECB recently. So what does the ECB mean? It means European Central Bank, and it is basically as close to our Fed as possibly can be made in regards to over 26 some countries that are part of the European Union. So it has lately been taking a much more dovish thought in regards to the economy as euro and the yields fell. But continued accommodation by global central banks, including the ECB and the Bank of Japan, currently outweigh the impact of the Federal Reserve's rate hikes campaign, and recently implemented a balance sheet, that balance sheet normalization program that the Fed came out to say. But as the Fed's program continues to accelerate, and we're looking at higher rates here, at least in the month of December, ECB purchases are shrinking, and the other central banks, such as Bank of England, will shift towards more restrictive monetary policy. So we really believe that we may be moving forward to a time when central banks could begin to fade as the primary drivers of the markets, and the fundamentals may return to the forefront, which, boy, wouldn't that be a nice thing for the banks to get out of the way and let the economy be the economies and move forward. So that's the answer to the question. Was ECB mean the European Central Bank? Thanks for that question on Twitter. We're on Twitter at Farrell Wealth. You can also find us on Facebook and also any of the iTunes shows as well. Money Matters with Greg. You can find us in a number of different places, and certainly email us at greg@farrellwealth.com. I'd love to hear from you and be able to talk about it. I'm Greg Farrell, CEO and president of Farrell Wealth. It's a wealth management firm and a registered financial advisor. And we talk money on this show, so that's really basically what we do and how we do it, and anything we can do to be able to help you in regards to your portfolios is what, and your overall wealth. Anything we can be able to help with, we'd be happy to help with. So I want to talk about thought leadership program that we've come out with and had really on a quarterly basis. We've had a number of different pieces that are put out by ourselves and LPL Research. You can find LPL Research at LPL Research on Twitter. Highly recommend you follow them for as much as they have. They are our broker-dealer, and many of the things that they do are just excellent in regards to bringing up questions about your wealth. And I always like to be able to share a lot of different things on this show about them. You'll see many of my Twitter posts and comments are LPL Research leaning for sure. This is excellent. And there's a number of other things too. We just posted a number of things on Bloomberg, and all the things we're reading we post on Twitter. So please, give us a follow on Twitter to be able to see what we're reading, what we're doing. But in regards to how healthy is your life portfolio is the question is. There are portfolios in this world like we just talked about in regards to the market, but what about your life portfolio? And for most people, thinking about the economy starts with their personal financial situation. What about me is really the question. And so while you start thinking about job prospects or health of a business or prices at the pump, all of these have impact on how we feel about the economy. And the bottom line is really, how is my family doing? How am I doing as an individual? And in order to sort of capture this perspective, this sort of designed an alternative way for investors to think about markets and the economy, and which is referred to as a life portfolio. Now, the life portfolio provides a snapshot of the U.S. economy from a perspective as a typical American household. And while we use it to look at the bigger picture, it may also provide important insight on our personal financial situation as you think about how you are doing, where you want to be, and how you might get there. Taking the life portfolio approach really means starting with three basic important aspects or parts of the household finances, and those three things are real simple. It's income, debt, and assets. And then you look at how they collectively reflect your financial well-being as a family. So if you examine the U.S. overall, our analysis really shows that while income and debt levels have improved since the Great Recession, our assets have seen the most dramatic increase. Now, this overall trend may provide some context to your individual financial situation as you consider how your own income, your own debt, and your assets have changed over time, but the potential opportunities are really that path forward. And when you look at the financial condition based on these three areas, considering both our current state and our future prospects, we really can determine the right course of action as to where you want to go. So basically it's an analysis type situation and then sort of monitoring from there on. But you might be able to, in having that analysis, go through the mindset of making changes to an investment portfolio, or potentially you may shift your mindset to choose to focus more on long-term goals and life events rather than market events that you see, in a more volatile short-term type thing. So when it comes to your finances, you may be saying to yourself, I'm doing okay, but could I be doing great? Or I'm doing well, could I be doing better? Looking through the life portfolio lens, you can really offer a new way to kind of answer this question. That's why I bring it up. So when you're breaking down your life portfolio, for each component of the life portfolio, you have income, debt, and assets. We've really developed the statistics that kind of show how things are today, as well as indicators as to how they can be better or worse in the future. So what we find is that our financial situation has improved. Stocks are hitting all-time highs, while unemployment and inflation continue to trend downwards. Now, this is good news, but how is it affecting households? By assessing this household income, debt, and assets, we can really determine that broad economic and market growth we're seeing is affecting the actual financial situation of American families. And look, all it takes is to just look around when you go to a restaurant, or when you go to, or you see the UPS driver coming up to different houses, dropping off Amazon boxes. These are things that are picked up in recent memory. You know, you might not, where before you might go to a mall to see how many bags people are carrying. With the way the world is now and the economy, it's not necessarily the best indicator. But you go to the restaurants and you see them packed to the gills and there's a waiting line. People are they seem to have more money in their pockets and they seem to be spending it. So, and it's because the economy is doing better, they have jobs, they are employed, and it seems like things are better. So that's definitely what we're finding, and we're definitely what we're seeing. You can see it in the different trends that are out there, and we're all about trends, and we're making sure you're watching trends in regards to money. So you just start seeing some of these things. But again, this whole conversation about your life portfolio is about you. But when you start looking at income, the one thing that is not keeping up is the overall income. Now, when you analyze income based on annual wage growth in real inflation-adjusted dollars, and you capture the typical American family by using that median or that actual middle American family number rather than the average, for the past 20 years, wages in the U.S. have not kept up with inflation. And in fact, since 2007, the real median income has actually declined by 2%. So that's really important. So while the stock market and unemployment rate have recovered from the Great Recession, income is significantly lagged. And we also look at what opportunities lie in the future. So that's basically what's been going on in the past is, income really hasn't kept up. But in other words, what are your realistic chances of improving your income? We look at several metrics here, and such as overall hiring trends and a number of new jobs created. We also pay particular attention to the number of unfilled jobs, and historically an increase in the number of unfilled jobs has led to an increase in wages. Since 2015, the number of jobs available has continued to rise, but without the usual increase in wages. So we think the relationship really continues and expect that wages will begin to increase to reflect the job market over time here. In regards to debt, so we talked about our overall assets, and we talk about our income, and then we talk about our overall debt. In regards to this life portfolio and how it affects you, let's talk about debt. Our number one concern is paying off debt, is a consistent concern for Americans, and it's often rated as the top financial problem in Americans' concern overall. This absolute level of household debt in the U.S. has been increasing since the end of the Great Recession. But it's important to sort of look beyond that. When you examine debt, we look at the ability to service that debt. And so do banks, and so do many of the lenders, which is also a function of our incomes and the interest rate on our debt. So years of low interest rates have increased our ability to service our own growing debt, and thereby keeping the debt burden low. And in fact, collectively, our ability to service our debt is as good as it's been since 1980, which is incredible. So that's really, really good. That's done from the Federal Reserve research from back in May of 2017. So your debt service payments as a percentage of disposable income have been higher because interest rates have been lower, which is great. So you look at that, so that's the debt side. What about assets? Well, assets, the asset level in the area of the most significant improvement overall is really positive outlook. Assets are an important element of overall net worth, which subtracts out debt to show how your assets, how many of your assets are really yours versus other people. For instance, that 401k that you have that has done so well, or that retirement account that's done so well in the market in regards to the overall investment markets, how much of it is yours? Uncle Sam has never seen many of these accounts because they're tax deferred type accounts. So you might say, well, I have $10,000 or $50,000 or $100,000 in a 401k plan. You have to remember that 20 to 30% of that is not necessarily yours. Now, how you minimize that tax exposure is up to you and your advisors and your team and everybody else you work with as you go through retirement. But in regards to what you own versus what you might own in the future, all those things might change. So asset prices really, you start looking at well above the lows hit in the Great Recession. The stock market is more than tripling since its lows, and house prices recovering on a national basis. This is an important trend that not everyone is participating in these markets. So the percent of adults even owning any kind of stock investment declined from 65% in 2007 to 52% in 2016. And the home ownership rate dropped from 68% to 64% over that same time period. So you really need to, when you start talking about the average American out there, things are moving right along and clipping right along, but income has not kept up with inflation. The debt has improved. Assets have soared to new highs, but not necessarily everyone has participated. So how do we put it all together in the last 5 minutes of the show here? Well, look, you want to compile all the data at each component and try to figure it out and look at what we can see on how these elements, they don't always move up and down together, and they don't always push and pull against each other at times. But when we combine our data across all three of these levels that we've been talking about, we see a pretty positive picture on where we stand now, supporting the idea that we're experiencing a lot of all-time highs and great improvements since the Great Recession. However, we also take a closer look at this separated data series. We can see that assets are propping up the overall line. So how do we help income and debt to catch up to assets and start contributing more to our life portfolio? Well, you want to uncover why assets are propping up the life portfolio overall and how we can try to balance that out. One direction is look at the policy shift to the Federal Reserve. Through its quantitative easing programs, the Fed has made $3.8 trillion in investment into the economy, which has continued to $18.9 trillion in stock gains and $4.8 trillion in housing gains, but only $2 trillion in income gains. So isn't that interesting? That goes to our point of how incomes necessarily haven't risen. That means that for every $1 invested by quantitative easing, we have only seen a 0.53% return for income. Not a very good income return on investment. And while stocks have seen a $4.97 return for that same dollar invested. So low interest rates have helped to fuel the asset prices, with much of a smaller impact on the real economy, which really explains some of the discrepancy between the high asset level and the moderate progress in income. So as the economy shifts from the Fed-driven monetary stimulus to fiscal stimulus via tax savings and target spending, we should really start to see more of a positive impact on income, as income should rise and wages should rise as well. So another area to watch is business spending. We talk about this all the time on the show, is what's going on in the business community out there. And for our economy to continue to improve, we need higher business spending. It's been particularly weak when analyzed as an overall percent of GDP. Business spending as a percent of GDP is currently below 3.5%. That is one of the lowest levels in more than 20 years. Now, low business spending may be due to recent earnings recession, which we talked about in 2014 to 2016. But as earnings continue to improve, which they are, we may see businesses start to reinvest and increase their spending levels, which could support the overall economy. You also talk about any sort of tax plan, if possible. Smaller businesses will get a massive jump in their corporate tax abilities. You also talk about repatriation of money and new money that might be coming overseas. That'll be like QE10 in this country. So you really have to be able to think about all these different things as they come along as to how they might affect your life portfolio. But income is lagging, so that's really where's the next move. So in review of all this, I only have a couple minutes here to be able to finish up, but the concept is you really want to focus on life events, not market events. The concept of a life portfolio provides another frame of reference for evaluating the U.S. economy, and your financial situation. So focusing on your income, your debt, and your assets may lead you to consider new ways to improve your finances is the point. But if many of us, as we try to it can be difficult to relate to numbers we see on a portfolio statement or these tangible improvements in our lives. Instead of focusing on market events and your monthly, quarterly, or even annual returns, try to think holistically about the life events you've experienced and achieved after years of investing. You may have been able to start a business or buy a home, pay for a child's education, set up a comfortable retirement, or establish a legacy for your family of some sort. Those sorts of things are life events, and they're very important. Another life event, it was a nice goal to have, is get a will. Plan accordingly for you and your family to make sure you're organized. And an increasing number of advisors that we see out there are using goal-based planning tools to kind of help you with this process. And as you work closely with an advisor or tax attorney or accountant on your overall financial situation, just remember the life events you're experiencing and those you're working towards can really have a profound impact on your overall mindset and keep you on track to reach your financial goals. All right, so that's my life portfolio question is, how is your life portfolio doing? We're out of time here on the show. The show is Money Matters with Greg. I'm Greg Farrell, CEO and president of Farrell Wealth. It's a wealth management firm local here in Valparaiso, Indiana, but then servicing clients throughout the nation. We are always welcome to answer your questions at any time. You can find us on Twitter at Farrell Wealth. You can find us on Facebook at Farrell Wealth as well. Podcasts are on iTunes. Money Matters with Greg is the search tag for that. And then you can always just call us at 219-246-2516. We'd love to hear from you. The show is Money Matters with Greg. We're on WVLP 103.1, local here at FM and the show station. If you ever want to advertise or be a part of this program or any other program on WVLP, just call us here at 219-476-9000. And we'd love to hear from you any day. I hope everyone has a very profitable and fantastic week. Happy Halloween to everyone. Make sure not to eat too much candy and get a sick stomach. We'll talk to you next Monday. Thanks. See ya.